All right, welcome everyone to this deep dive. We've got a stack of sources here landed right on our desk, and they're suggesting something pretty interesting.
Oh, yeah. What's that?
Well, certain well-known stocks, names you definitely recognize, they've been, struggling a bit lately, but the idea is they might actually be set for a comeback.
Okay, interesting premise. And the sources give some context for that.
They do. The context they lay out is, well, the market overall has been rallying, right? But these specific stocks, not so much. They haven't really followed along.
Right. So they're lagging behind the general trend.
Exactly. In fact, the source material points out they're trading significantly lower than they were just a year ago.
Okay. And does the source get into why they're down? Because, good stocks don't usually tank in a rising market without a reason.
Yeah, it's pretty upfront about that. It acknowledges these companies aren't exactly firing on all cylinders right now. The source basically says you don't see a stock lose like a third or more of its value if there aren't some, real issues going on.
Makes sense. So despite these issues, the source thinks they can bounce back.
That's the core idea here. Despite the recent stumbles and these pretty steep drops, we're talking down at least 33% over the last 12 months. For these names, the source says they have, and I'm quoting here, compelling reasons to recover.
Compelling reasons. Okay. Right. Almost like they're coming out of what did the source call it? The market's penalty box?
Yeah, exactly, the penalty box. And the source material, it really zooms in on three specific companies for this potential bounce back.
Yeah.
Target, ticker TGT.
Okay, Target. Got it.
Celsius Holdings, CELH.
Celsius, right. The energy drink.
And Freshpet, FRPT.
FRPT. Freshpet. Okay. And anything else we should know about the source itself?
Just that the author mentions they're actually a shareholder in all three of these. So important disclosure there.
Right. Definitely good to know. So our mission then for this deep dive, sticking strictly to what these sources tell us, is to really unpack why. Why these three? What are the key arguments, the data points the source is using to flag them as potential recovery stories?
Okay, let's do it. Let's unpack this source material. Starting with Target, TGT. The source notes down 33% over the past year.
Yeah, 33%. And the source basically puts this down to a rough few quarters. Simple as that, really.
Rough how?
Well, they've seen store comparable sales. Sales at established stores actually turn negative.
Ouch. Compared to last year.
Exactly. And they're coming off back-to-back quarters where overall net sales have declined. So that's the operational challenge the source is highlighting right there.
Gotcha. Now, that big drop in the stock price, it had another effect the source mentions. Something about the dividend.
Ah, yes. Good point. That steep drop, it pushed the dividend yield up to what the clause calls a beefy 4.6%.
Beefy. Okay. And is that a big part of the argument?
It seems to be a key part, yeah. Especially when you look at Target's dividend history. It's what they call a dividend king, meaning they've increased their dividend payout for, get this, 53 consecutive years.
53 years. Wow.
Right. And the source makes a timely point here. It notes that historically, Target announces these hikes right around this time of year, usually between June 9th and June 15th.
So we could be looking at number 54 very soon.
Potentially. That's what the source seems to be suggesting.
And can they afford it? Does the source touch on that, given the sales declines?
It does. It notes that currently, Target is paying out less than 50% of its trailing earnings in dividends.
Okay, so less than half.
Yeah. And even looking at their guidance for adjusted earnings this year, they're projecting between $7 and $9 per share. That translates to a payout ratio somewhere between 50% and 64%.
So still manageable.
The source frames it as having wiggle room, suggesting they aren't, stretched thin covering the current dividend and maybe could even bump it up a bit.
Okay, but that brings us back to the struggles. Why has a big retailer like Target been having such a tough time with sales? Is it just the economy?
Well, the source points beyond just economic headwinds. It notes Target has some work to do winning customers back, specifically because it became, quote, political.
Political? How so? For a big retailer like Target?
Yeah, the source suggests it's not really ideal for a mass market brand, and it apparently managed to upset people on different sides.
Okay, can you give specifics? What does the source say happened?
It mentions a couple of things. A few years back, it notes some conservative customers got upset over a certain third-party merchandise. They felt it didn't really fit the brand, I guess.
Okay.
And then more recently, just this past January, the source highlights that some liberal shoppers were unhappy when Target announced it was ending certain DEI, diversity, equity, and inclusion initiatives. So I saw that as, a step backward.
Huh. So getting criticism from both sides, according to the
There's-
source.
Seems like it. So the source kind of paints this picture. You've got the operational sales challenges plus these perception issues that landed the stock in that penalty box.
Right. So what's the takeaway on Target then, based on the source?
The view presented is, look, turnarounds take time. Things don't fix themselves overnight. But the source suggests that chunky 4.6% yield is kind of your reward for being patient while the company works through all this stuff.
So the yield helps you wait it out.
Basically, the key thing, as the source sees it, is that these turnaround efforts don't end up costing so much that they, have to scrap that potential dividend hike. Because that dividend, especially for income investors, is a big part of the appeal right now.
Got it. Okay, let's shift gears. A very different company the source flags is Celsius Holdings, CELH. Now this one, the source says, has been hit the hardest of the three over the past year, down 42%.
Yeah, a big slide, 42%. But here's where the source throws in a real curveball, something kind of counterintuitive.
So,
Despite that really rough year-over-year drop, the source also points out that Celsius is actually one of this year's biggest market winners. It's up more than 60% just since the start of January.
wait, what? Down 42% over the year, but up 60% year to date. That's volatile.
Exactly. That contrast, that volatility, it's a huge part of the Celsius story presented in the source.
Man, narratives can change fast.
Yeah.
So before this recent slump, what's the story? The source mentions its growth.
Oh, yeah. Before this year-over-year dip, the source describes Celsius's growth as scorching hot. Revenue literally more than doubled every single year from 2021 through 2023.
Doubled every year. Wow.
Yeah. And even with last year's drop factored in, the source notes it's still been a 12-bagger stock over the last 5 years. Just incredible growth.
Okay, so why the big year-over-year slide then? What changed?
Well, according to the source material, it's precisely because that period of torrid growth, as they put it, started to moderate. The last 3 quarters actually saw year-over-year declines in revenue.
Ah, okay, so the growth engine sputtered a bit.
Exactly. And that's what really humbled the stock and led to that big annual drop the source highlighted.
So what about the bounce back this year? That 60% gain, where's that coming from, according to the source?
The source ties that recent effervescence, as it calls it, directly to a specific strategic move,
Which was?
the acquisition of Alani Nu.
Alani Nu, another energy drink company.
Yeah. The source describes that deal as accretive, meaning it's expected to boost Celsius's earnings per share. Alani Nu is described as a smaller but fast-growing maker of energy drinks, and crucially, it targets a different niche than the main Celsius brand.
Okay, so the idea is that bringing them together is the catalyst for this recent surge.
That's the core argument presented in the source, yeah. It says that combined, Celsius and Alani are actually gaining market share even over the past year.
Even with Celsius's individual recent declines.
Apparently so, when you look at them together. And the Alani Nu deal, it just closed at the start of April. So the source anticipates that the results, even on a pro forma basis, like adjusting the numbers as if they'd owned Alani Nu for longer, should turn positive starting with the current quarter.
Right now, basically.
Exactly. So for Celsius, the whole bounce back thesis presented here really hinges on this acquisition turning the ship around after that period of slowing growth and declines.
Interesting how one deal can potentially shift the whole narrative. Okay, let's move to the third stock the source highlights. Freshpet, FRPT, down 39% over the past year, the source says.
Right, Freshpet. And the source positions this one as pretty unique, one of the more differentiated players in the pet food space.
Differentiated how?
Well, it might only have, say, a 3.5% slice of the total U.S. dog food market, which sounds small, but the source emphasizes where it dominates. It holds a whopping 96% chunk of the fresh or frozen pet food market sold in physical stores.
96% of the fresh stuff in stores. Wow.
Yeah, basically owns that niche in brick and mortar. That kind of specific market share is a key point the source really leans on.
And they have those fridges everywhere, right?
Exactly. The source points to, 28,531 Freshpet branded fridges, just selling their food for dogs and cats. You see them in supermarkets, convenience stores, and guess where else?
Let me guess. Target.
You got it. Target. A little connection back to our first stock.
Huh. Okay, so that's presence, this niche dominance. It helped them grow.
Absolutely. The source credits the setup, easy access, unique product with making Freshpet a really consistent growth stock for a while. It notes they had 7 straight years of at least 27% top-line growth. That's a solid run.
7 years above 27%.
Okay.
But obviously something changed, given the stock is down nearly 40% in a year. What happened, according to the source?
Yeah, that winning streak seems to be over, at least for now. That's the issue. The sources, they started this year forecasting revenue growth between 21% and 24%. Pretty good.
It's still strong, yeah.
But they recently had to revise that forecast down quite a bit. Now they're only expecting 15% to 18% growth this year.
Ah, so a significant slowdown from that historical pace.
Exactly, and that deceleration is what the source points to as the reason for the stock taking a hit.
Okay. What about valuation? Does the source talk about that? Because growth stocks often trade at high multiples.
It does, and it's a really interesting point here. Because Freshpet was a high-growth star, and the source says it had this widening audience, high switching costs. You know, once your dog loves the fancy fridge food, you're probably not switching back easily.
Right, makes sense.
So because of all that, it commanded a hefty premium, a high valuation, and even after dropping almost 40% over the last year, the source notes the stock still isn't cheap.
Still not cheap, even now.
Nope. According to the source, it's trading for 3 times sales and 37 times next year's estimated earnings. So, yeah, still pricey by traditional metrics.
Okay, that's a key point from the source then.
Yeah.
Still expensive.
Yeah.
So how does the source square that with Freshpet being a potential bounce-back candidate? Doesn't seem obvious.
Well, the source's concluding thought on Freshpet is basically conditional. It suggests that if, and it's a significant if the company can get back on track, re-accelerate its growth towards that historical pace, then despite the current valuation still being kind of high, this recent big drop in the stake price could still be seen as a historical buying opportunity.
So the logic is the potential return to faster growth is worth the current price if they can pull it off.
That's the view presented, yeah. It's betting on a return to form, basically leveraging that dominant niche position, but it relies heavily on them executing that turnaround and getting growth back up.
Okay, all right. Let's try and pull this all together then. We've got these 3 specific stocks from our source, Target, Celsius, Freshpet, all down significantly over the past year, but all flagged as potential bounce backs.
Exactly. And crucially, the source gives very different reasons or, potential catalysts for why each one might recover. It really reflects how unique each company's situation is right now.
Right. So for Target, TGT, the argument presented is mostly about that dividend yield, that beefy 4.6%. It's income, reward for investors while they hopefully wait out the turnaround from the sales slump and those political perception issues the source mentioned.
Yep. Yield focus there. Then with Celsius, CELH, it's a totally different story. Despite that huge year-over-year drop, the bounce this year and the potential going forward is tied directly to that Alani Nu acquisition. The source expects that deal to drive positive results again, gain market share, and kind of change the story after that growth slowdown.
Acquisition-driven catalyst. Got it. And then Freshpet, FRPT. The source's bounce-back thesis there is all about the potential for them to get back to faster growth after lowering guidance. It's about leveraging that really dominant niche they have in fresh pet food.
Even though, as the source itself points out, the valuation isn't exactly cheap, even after the stock's big fall, it's a bet on growth reacceleration.
So the source is clearly framing these as stocks may be worth considering, right? If you're looking for companies that have been knocked down, put in that penalty box, but might have specific reasons to climb back out.
That seems to be the overall message from the source material we looked at. Different problems, different potential fixes.
Okay, so based only on everything we've dug into from the source material in this deep dive, here's something for you, the listener, to think about. The source presents these 3 stocks, all down big over the year, as potential bounce backs, but for very different reasons, right? You've got a dividend play with Target, an acquisition story with Celsius, and a bet on niche dominance and growth returning with Freshpet, despite valuation worries. Given these really varied catalysts and situations laid out by the source, how might you think about weighing these different kinds of potential bounce-back opportunities presented here? Something to mull over.